High Mount Research Market Insights video for April 27th, 2023. Good afternoon, everybody. Willie Delwich here. Glad you're tuning in. Glad you're listening again to our weekly Market Insights video where we don't break down everything that we could talk about in the world of finance and the economy, but focus on one specific area of the market, something that's, I think, topical and newsworthy, digested in a good manageable section rather than running through a whole bunch of charts. Today, we're going to talk about the data that we got this morning from a GDP perspective. So kind of the latest look at what we're seeing from the economy, or at least as of the end of March, and then what sort of implications that might have on what the Fed's going to do at their FOMC meeting next week. So let's get into it. Looking here at real final sales to domestic purchasers, why this rather than the overall GDP number? Well, the overall GDP number came in a little bit light today, a little disappointing. But if you look beneath the surface, a lot of the slowdown in growth was actually due to inventories being drawn down. So when inventories are brought down, that's actually a negative input to GDP growth. So real final sales to domestic purchasers takes that out. And what you see when you look at the data, quarterly growth surged in the first quarter. So I mean, we've been in the camp that there's been more weakness beneath the surface. When you look at retail sales, real retail sales haven't gone anywhere in 2 years, for example. Real weekly earnings have struggled to grow, and they're no higher now than they were pre-COVID. But this data is what it is. And so we don't want to discount it as not being the case and say, no, that didn't happen. But we can also be a little bit skeptical about the persistence of it going forward. Either way, is final sales, final demand, if you will, in the economy was relatively robust in the first quarter. So that's as the Fed is thinking about what they're going to do in terms of raising rates, of pausing. This seems to give them a little bit more leash in terms of saying, okay, the economy is weathering at least some of these storms pretty well. There's no need to take kind of quick action right away. You see the same sort of thing when we look at the St. Louis Fed stress index here. That's the blue line on top. We've inverted it because I want to compare it to the KRE, the regional bank ETF. But so by rising, in this case, the stress has come down. It's actually back to where it was in February. So those concerns, those bank-related stresses that emerged in March, they've been completely undone from a stress index perspective. What's interesting is that the market doesn't totally agree with that from a bank stock perspective. Here's a KRE. Not only has it not recovered, it's actually making new year-to-date lows right now. So the question from that perspective is the Fed focusing on the data, or is the Fed going to focus on the market reaction? Are they going to look at what's happening from one of their own evident indexes of stress, or do they say, well, market prices haven't bounced back, so we need to take that into consideration? You can see the market is kind of taking the later view that maybe there is some concern or reason to be concerned still. Remember, the stress index, that looks at spreads, high yield spreads, things like that. When we talk about the market now, we're looking at the 2-year yield. And early in the rate hike cycle, yields were saying, Fed's got to raise, Fed's got to raise, Fed's got to raise. Fed finally listened, started to follow the lead of the market. But, this year, it's kind of been the Fed setting the course. The market was a little bit less sure that the Fed needed to continue to raise rates, but the Fed did in January. They did again in March. And actually, when they raised rates in March, the market kind of moved in the opposite direction. That's that 3.78% yield on the 2-year there. That was the day that the Fed raised rates. So we had this 100 basis point spread between the Fed funds rate and what the market was thinking the Fed funds rate should be. And since then, a little bit of volatility. The market certainly isn't buying this view that the Fed's going to or should continue to raise rates going forward. Why does the Fed feel like it needs to, if not raise rates aggressively, at least keep rates high for a while? And we'll get into kind of what its next steps will be. But what is the impetus for further action on the part of the Fed? It's inflation. Also in the GDP data this morning was the quarterly look at PCEX, Food and Energy Price Index, core inflation. I'm not a big fan of the monthly core indexes. I think we can use better data to get a sense of the central tendency there. But from a quarterly perspective, these do a pretty good job. And if you look, the blue line there, that's where the Fed would like inflation to be, right around 2%. This is where, on a quarterly basis and not too far on a year-over-year basis, where it is now, close to 5%. Quarterly, it's a little above that. Yearly, it's a little below that. What's interesting is after all the aggressive tightening this year from the Fed and last year from the Fed, core PCE, core inflation accelerated in the first quarter. It actually turned higher. I mean, there are only two instances in the past 40 years where we had a higher quarterly rate of inflation from a core perspective. And this is a year into the rate tightening cycle. So, the Fed can maybe be relieved that the economy is not falling apart when looking at the final demand data, but they've got to be a little bit stressed out that inflation isn't coming down when they look at what's going on from a core PCE price index perspective. So I think that's the takeaways for the Fed from today's GDP data. I think is this: it's what's happening from an inflation perspective. What makes it all the more interesting is that this core inflation is still strong even as money supply collapses, money supply growth collapses. Now, you zoom out and we had this huge surge in money supply growth post-COVID. You can see it, the yearly changes and 3-month changes on the chart here. And so from a level perspective, we've only begun to unwind all that excess liquidity. But from a growth perspective, money supply growth down 4% over the past year, falling at a nearly 10% annualized rate over the past 3 months. That's the first quarter. That is what this data covers. So even as core inflation was accelerating, money supply growth was contracting at a never before seen pace. And so really some interesting cross currents for the Fed to navigate, for the economy to navigate. I think at the end of the day, the Fed hopes that contracting money supply will bring inflation down. So far, the evidence of that isn't exactly overwhelming. And so then what's the Fed looking at? What's the market looking at in terms of actions for this week and then for the rest of the year? So it's pretty broad consensus that the Fed will raise rates from 4.75% to 5%. It's like a 90% expectation in terms of futures. What happens after that, I think, is what really matters for the market. That's where the disagreement starts to emerge. The June meeting, there's about a 25% chance that the Fed would raise another 25 basis points. But the Fed's own dot plot from March suggests most of the members of the Fed think once they get to 5%, that's probably going to be enough. Now, it could be that the recent inflation data makes them think that they need to raise rates a little bit more. But regardless, that 5% is kind of okay. That's we can get to that and then hold at that level. That's been that keep them higher and stay higher for longer kind of mantra that the Fed has been focused on. The market doesn't believe that. They think, okay, raise rates in May and then hold them steady for 2 meetings, and then back half of this year, a series of rate cuts with continuing into next year, bringing, on a kind of a probability weighted perspective, market expects Fed funds rate to be 4.4% by the end of this year. The Fed thinks it's going to be just above 5%. So you have this big disconnect between where the market thinks the Fed is going and where the Fed thinks the Fed is going. You go back to that 2-year yield Fed funds rate chart, and a lot of people say, well, the Fed will have to follow what the market does. We'll have to see. This is a slightly different environment from a long-term perspective right here. And so it's going to be a little bit different. Certainly the market thinks the Fed will cut rates soon. It's not unprecedented to see the 2-year yield below the Fed funds rate. We've seen that numerous times before, but usually that happens when the Fed is already cutting rates. It is relatively rare. You got to go back. I think it's the early 80s to find an instance where the 2-year yield was below the Fed funds rate and the Fed was still raising rates. So the Fed is trying to tell the market to listen to it. The market doesn't want to, and hasn't too much so far. And so this creates if not historically unprecedented, at least unfamiliar territory, this disconnect between the market and the Fed. And zoom out, I think this chart goes a long way to explaining what the Fed is dealing with and why it's a little bit of a different regime right now than pre-COVID or really for the professional careers that many of us have had. So this is 10-year growth rates for GDP. The blue line on top is nominal GDP. Orange line in the middle there, that's real GDP. So these are 10-year growth rates in both. You can see pre-COVID, they were both starting to accelerate. We're seeing some broad upticks in the economy. The good news is that as we were seeing that acceleration pre-COVID, it was both real growth and nominal growth were accelerating. So the spread between the two was not meaningfully moving higher. Since COVID, something different has happened. 10-year growth rate on a real basis is moving sideways. On a nominal basis, 10-year growth rate is at its highest level in a decade. You combine the two and you extract the two. The difference, the spread, is essentially the inflation component, and that's at its highest level in 2 decades. And so we're seeing, from a sustained trend perspective, more inflation, more nominal growth, less real growth, which means more price pressure coming through. And the Fed needs to combat that. The Fed is okay, I think, if nominal growth is accelerating, if real growth is accelerating with it. That's not the case right now. Nominal growth is accelerating. Real growth is stalling. That's sustained price pressure. That's what the Fed is having to fight right now. It's not supply chains. It's not one-off disruptions to the economy. It's this long-term shift, goes back to some of the labor market imbalances that they have talked about that are underlying in the economy, that a quick shift, a quick pivot from the Fed only exacerbates some of those pressures. It doesn't help relieve those pressures from a long-term perspective. So then what are investors to do with this? We talk about not fighting the tape. I think equally important is not fighting the Fed. A chart here shows the percentage of global rates that are percentage of global central banks that are raising rates. It's around 90% right now. Top just shows what the S&P 500 does when a majority of them are cutting rates. That's the green line, versus when a majority are raising rates. That's the orange line. That's the regime we're in right now. And the results speak for themselves. Virtually all of the net gains since 1990 have come in that 2/3 of the time when a majority of global central banks have been cutting rates. So the takeaways here are pretty simple. The Fed has more work to do, if not from a rate raising perspective, at least from a rate maintenance perspective. They can raise next week and then signal to the market that they're going to pause. But if that is interpreted as pause leading to pivot, I think that the Fed is sending the wrong message, or the market is picking up the wrong message. The Fed, in order to kind of unwind some of the inflation pressures that still seem to be there, coming from the GDP data that got released today, the Fed needs to signal, okay, maybe we're done, at least for now, but we're going to stay at these levels for some time. That should bring yields higher, at least at the short end. 2-year probably needs to come up in line with where Fed funds rate is. And then at some point in the future, once there's more convincing evidence that either the bank crisis is reemerging, or better, that inflation pressures are actually unwinding, then the Fed can start to talk about glide path towards neutral. But right now it needs to keep policy tight for an extended period of time. That's the message I think that Powell will want to send to the market next week. That's the Market Insights video for this week. Thanks for listening. Thanks for tuning in. Willie Delwich here, hoping you have a great rest of your week and a great spring as it really turns from April into May, and weather warms up and flowers bloom and trees bloom, and you can finally start to get your plants in the ground and see what this year's garden is going to look like. So I'll talk to you again next week. Have a great week, everybody.